Invesco's Chief Global Market Strategist, Kristina Hooper, here with us now to continue this market conversation. So, Kristina, it is now halfway through the year. There's been a lot of choppiness in the markets lately as we've been getting some whiplash around the economic data. Curious to know what you're paying the closest attention to in the second half of the year.
Well, clearly it's inflation. I mean, what we've seen in recent surveys is that finally, after 16 or so months in which the pandemic was the biggest concern on investors' minds, it has changed to inflation. And so we want to follow inflation closely. And I would specifically focus in on inflation expectations. That's part of the equation for the Fed, right? They talk about how because inflation expectations are well anchored, we can maintain a very accommodative monetary policy. But what if inflation expectations become unanchored? And so we want to, in particular, follow consumer inflation expectations closely, just because that's an area where we've seen an increase recently, including as recently as last week with the Michigan print. That's not all, but I think inflation expectations are important. I also pay very close attention to the Federal Reserve Beige Book. That provides a lot of the color behind the data we're getting. It gives a sense of, for example, why employees aren't returning to work. And is it more temporary or more permanent in nature? Just one facet of it. But you can learn so much from it, including business spending plans. So I'm a big fan of the Beige Book.
You're not the only fan here of the Beige Book. Brian Cheung, also a huge fan of the Fed's Beige Book. But Kristina, I really quickly want to ask you, at least in terms of inflation, we were just chatting with Keith Fitzgerald a little bit earlier, and he mentioned that he thinks that the Fed is totally wrong when it comes to inflation and some of the moves. I'm curious to know what you make of an argument like that the Fed right now is getting it so wrong when it comes to inflation and inflation risks.
Well, certainly one of the biggest risks facing markets today is policy error. And so that's really what Keith is getting at, right? That the Fed is allowing inflation to overshoot and it's not reining it in. The reality, though, is that the Fed changed its inflation targeting policy last year to allow for inflation to run a bit. It's become a very different policy from what we are accustomed to with the Fed. Before, you could characterize the Fed's policy as taking away the punch bowl just as the party is getting going. Now, the Fed is likely to keep the punch bowl out for a while, even if some party goers get tipsy. So it's a big difference. Now, the question becomes, will it be a policy error? Will the Fed be unable to control inflation if it remains high and persistent? That's the $64,000 question. I tend to believe that inflation will likely be more transitory in nature. But having said that, we want to follow the data very closely on this.
Hey, Kristina, Brian Cheung here, and this seems to be the spirited debate about whether or not there is a risk of the economy overheating. But regardless of where you land on that policy debate, do you think markets have gotten the message from the Federal Reserve? Because it seems like they were doing a lot of the catching up in March when nominal bond yields were going up, but it seems like things have plateaued essentially since the middle of April. We've already seen also 5-year break-even rates in terms of market-based measures of inflation expectations come down as of the last few weeks. So do you think that this is basically the markets fully understanding and pricing in the Fed's new reaction function?
You nailed it. I think the Fed has really finally been able to get through to investors in terms of its communications. I think there was an awful lot of skepticism for months and real concerns about inflation rising. And the last couple of months have been characterized by a complacency, which says to me that investors have gotten the Fed's message and recognize how different its inflation targeting policy. Its acronym, by the way, is FAIT, F-A-I-T. I don't know if I'd want that as an acronym for a Fed policy, but they clearly understand that there is a new policy and it's quite different. Now, the question becomes whether or not that continues. You can see slight hesitations. There are days when we get data that is slightly unnerving to markets that suggests higher inflation, but we haven't seen any kind of long-lasting impact. So far, markets believe the Fed.
So if you wanted to adjust your portfolio to account for some of these inflation moves and concerns, exactly how should you be looking at balancing out that portfolio?
Well, that is a good question. And I think that one that requires something of a diversified approach. What we know is that historically, some asset classes have served as hedges in some inflationary periods, but not others. An example of this is gold. It has only, I mean, it's viewed as a strong inflation hedge, but the reality is that it's only worked some of the time as an inflation hedge. So you want to be very, very careful with gold. You want to, I think, be diversified. If you're going to use that as an inflation hedge, you want other inflation hedges. For example, inflation protected securities. Now, we don't have a really long track record with them. They were only developed in the 90s. So they haven't really been tested, but the way they're intended to work, they arguably should provide an inflation hedge. So that would be one component of a portfolio if you want to add some inflation hedges. Commodities as well, since inflation is running high.
And Kristina, I want to ask you lastly, just in terms of what you expect to see in the next Fed meeting that's coming up in about a week and a half. You think it's going to be pretty uneventful, or do you think it's possible that the Fed could give us a little bit more hints as to that tapered talk that it seems like some Fed officials have been eager to kick off?
Well, we're starting to hear different FOMC members get a little more vocal, and it's clear that there are some chasms. So I would expect that to be at least on display in the FOMC minutes. So we won't get it from the meeting itself. We'll probably have to wait till the FOMC meetings, but we'll also get it from Fed Speak, because we are going to be hearing from a number of Fed speakers in the course of June. So we'll get some preview, but it's clear that some want to talk about tapering and perhaps even start tapering soon, while others aren't even ready to talking about tapering.